The Jared Dillian Show.
I'm Jared Dillian. This is the Jared Dillian Show. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. It sounded a little funny there. It sounded weird coming through the headphones. Threw me off. Let's talk a little bit about diversification. It's a good topic considering what's going on in the market. Big rally for the NASDAQ today. The NASDAQ was up 4%. Tesla added $100 billion to its market cap in one day. People are pretty excited about this, and I think it's a bear market rally. I think this is usually when you see impulsive corrective waves like this, it's not a healthy technical sign. Usually it's bad. But anyway, this should illustrate the problems with having too much in one stock. I mean, there's a lot of people who have all their money in Tesla or all their money in Bitcoin or fill in the blank. And if you had all your money in Tesla, you took a 35% drawdown in the span of a couple of weeks. That's no good. This is not investing. This is not how investing is done. I had a conversation with somebody today. This woman was asking me if the market was causing me some stress. And I said, no, it doesn't cause me stress. And she says, well, there's this big rotation going on and growth and value and all that. There's a lot going on in the markets. And I'm like, no, it doesn't cause me stress because I build a portfolio that is diversified so that I generally, I've minimized my volatility, and the day-to-day moves in the market don't stress me out at all. No stress. So I'm going to tell you a story. Now, back when I was at Lehman Brothers, a lot of my colleagues really liked working at Lehman Brothers. It was a great place to work. And they believed in Lehman Brothers. They drank the Kool-Aid. They believed that Lehman Brothers would one day eventually become the biggest publicly traded investment bank. And we were on our way. We were the third biggest bank behind Goldman Sachs and Morgan Stanley, at least standalone investment bank. And, we had a chance to be number one. And a lot of people thought it would happen. Now, if you worked at Lehman Brothers, you already got a fair amount of stock. Okay, so a lot of your compensation was in stock. So I was a vice president, so 25% of my compensation was in stock, which is a lot. Now, this was restricted stock, which means that I couldn't sell it for 5 years. And it's kind of interesting, the tax consequences of this. Let's just say you got paid $1 million and $250,000 of it was in stock. So only the $750,000 was taxable. Okay. The other $250,000 wasn't taxed until the stock vested in 5 years, at which point you could sell it. And then you would pay the tax on it. Okay. Now, the interesting thing about Lehman Brothers is that their lockup period was longer than all the other banks. All the other banks had restricted stock that was restricted for 3 years, and Lehman Brothers had restricted stock that was restricted for 5 years. This is a very crucial distinction. I started working at Lehman Brothers in 2001, which means the soonest that I could sell my stock was in 2006. And I didn't get much stock in 2001, so I sold a tiny bit of stock in 2006, a tiny bit of stock in 2007, and then the firm went bankrupt in 2008. So out of the $500,000 worth of stock that I had, I only got to sell maybe 15,000 of it. That was not a very good deal. Now, my philosophy was to sell whenever I had the chance. Every time there was an opportunity to sell, I took it. Because the stock was about 25% of my net worth, which is too much in one stock. You don't want a stock that's 25% of your portfolio, especially if it's the company you work for, because it's all correlated. It's all tied together. Because if the stock goes down, it means that something bad is happening at the company and you might lose your job, which means you lose your job and lose your stock at the same time, which is like the worst case scenario, But I still lost $500,000 at the bankruptcy, and that was a big hickey. Losing 20% of my net worth all at once and the rest of my portfolio got hammered too. Now, it would have been nice if I didn't have so much stock in my employer. Okay, so think about this. I had 25% of my net worth in the same company where I worked. So if the company went bankrupt, not only did I lose my job, I lost 25% of my wealth. It's a crap sandwich. Everything bad happens at the same time. But it was worse for some people. I was just a VP. Lehman managing directors routinely got 75% of their compensation in stock or options, which is fine when the stock was going up. At Lehman, the 401k plan had Lehman Brothers stock in the 401k plan. So you're getting it as part of your compensation, and you had the ability to buy more in the 401k plan at a 10% discount. So if the stock was trading at $80, you could buy it at $72. You could buy it at a 10% discount and hold it in your 401k. And there were some people that were doing that. There were some people that were just long a boatload of stock, and the stock went up for a long time. It worked until it didn't work anymore. And I said, no way in hell am I doing that. My fortunes are already tied to Lehman as it is. Now, of course, you know how it all played out. All the other banks were saved. Bear Stearns was bought by JP Morgan for $10 a share. Merrill Lynch was bought by B of A. But Lehman was the only firm allowed to fail. And it's really been the only company that's been allowed to fail in the last 13 years. By the way, a lot of people don't know their history. Okay. They think that Lehman was bailed out. And I guess it was a long time ago now. 13 years is a long time. If you're 22 years old and you were 9 years old when this happened, then maybe you don't really know your history. But gosh, I was there. It was not bailed out. I can tell you that we went bankrupt. It happened. Now, Barclays, which is another bank, did buy the broker-dealer operation out of the holding company. So a lot of the investment bank employees got to keep their job. And I could have kept my job. I could have stayed there, but I decided to leave and start my own business. And everybody thought I was nuts, NVTS nuts. Anyway, the right amount of stock to own in your own company is pretty low. And I would suggest 10% of your net worth. You want every opportunity you get, you want to sell that stock and turn it into food. It's just a matter of risk management. We've talked about position sizing before. What weight do you want of a position in your portfolio? It depends on conviction. Now, the one counter argument to this, I will acknowledge that this is a possible counter argument, is that if you work at a company, you essentially have inside information. You have inside information on the company. So, you're not technically an insider unless you're a director or an officer of the company, but you do have way more knowledge of the company than somebody outside the company. So you do have some asymmetric information. And if you have asymmetric information and the company is doing well, then I guess that is an argument for a larger position. But, a lot of people at Lehman Brothers, when things started going not so well, they didn't really get the hint. So it's a matter of risk management. What weight do you want of a position in your portfolio? It depends on your conviction. And you got to ask yourself, out of the universe of possible companies that you can invest in, out of all the companies out there, do you think that the one you're working for is the best investment out there? Maybe not. I have a 30% position in my portfolio. It's gold and gold miners. The biggest position I have in an individual stock is about 5% of my portfolio. And given the fact that you have something called correlation, you work there too, you should be really careful about loading up on a bunch of stock, especially in your 401k. You do not want to be messing around with your retirement savings. Now, there was a culture at Lehman. Some people were buying stock in their 401k, but there was a culture of selling your stock when you got it. At Enron, everybody was loaded to the gills on Enron stock. People were encouraged to buy Enron stock. You had people that were absolutely stuffed with Enron stock. Everything was an Enron, and they were totally ruined. I suppose this is one of the nice things about working in a small business. And this is part of a larger discussion on portfolio management. You really have to be careful with position sizes. I've talked before about a guy who made 50% of his portfolio one stock, Tesla. And that worked until it didn't. And if you do that, you are going to experience breathtaking volatility. I mean, unless the stock that you have all your money in is Procter & Gamble. But that is a lot of stress that you don't need. As always, it comes down to financial stress. We are not here to experience financial stress. Now, there are some people out there who want to experience financial stress. Hedge fund managers want to experience financial stress, VCs, but not you. You have enough other stress in your life. The two sources of financial stress are debt and risk. This is the risk part. You don't have to take huge amounts of risk to retire comfortably. You can do the awesome portfolio. It has great returns with almost no risk. It has a 9% max drawdown. And max drawdown is very important. What is the most amount of money that you can lose in a single year? And that determines your behavioral response to the losses in your portfolio. I'm Jared Dillian. This is The Jared Dillian Show.
The Jared Dillian Show.